Hey there, fellow investors. Welcome back to our channel, where we dive deep into the exciting world of finance and help you make those money moves. Today, we're tackling a topic that might sound scary at first, but fear not. We're here to guide you through investing during a recession like pros. So grab your favorite snack, sit back, and let's ride those market waves together. How to invest during a recession. You need to plan ahead to position your investment portfolio for an economic downturn, even if the next recession is forecasted to be mild. During a recession, cash is king. Cash is king during economic downturns, according to Citi Global Wealth advisor Michelle Griffith. As businesses tighten their belts and job losses grow, it's better to be safe than sorry and beef up cash reserves during times of high employment. Selling investments to raise money in advance of a recession is risky, though. You can sell too soon and find yourself stuck with cash as markets increase. A better course of action is to switch to investments that can withstand a downturn. This is why it is usually a good idea to retain a portion of your portfolio in cash or highly liquid securities, such as a money market mutual fund. Purchase defensive stocks before a downturn. When the economy is expanding, consumer discretionary equities frequently experience significant increases. Because the gains and losses in this group are based on the ups and downs of economic cycles and consumer confidence, they are known as cyclical stocks. Utility stocks and consumer staples stocks are examples of defensive names in non-cyclical sectors that are typically sheltered from these ups and downs. Defensive equities can help safeguard your portfolio during a recession. Companies that provide necessities like food, energy, and housing are typically non-cyclical and less vulnerable to economic cycles, according to Katz. Food, beverages, and home products are examples of consumer staples whose sales are mostly recession-proof because whatever the state of the economy, people still need to eat and use toilet paper. Demand for utilities also holds up in a recession, helping utilities outperform other stock sectors during a downturn. The healthcare sector is stable across the business cycle, wrote NBER analysts in a 2021 report. If anything, when counties experience more severe economic downturns, healthcare employment seems to increase. Use dollar cost averaging. With dollar cost averaging, you buy a predetermined amount of an investment on a regular basis, regardless of the price. Dollar cost averaging is an excellent strategy to utilize during recessions, since it allows you to buy shares when the price falls. With new funds, you can dollar cost average, or you can get the same result by having your dividends automatically reinvest in the security. Buy quality assets during a recession. Investors should seek out quality across asset classes to protect a portfolio during a downturn, says Katz. The characteristics of high-quality investments are low beta, high returns on investments, and minimal leverage. He refers to these businesses as all-weather businesses because their success or survival is not reliant on economic expansion. Businesses with strong recurring revenue, such as those with subscription-based sales strategies, are less vulnerable to downturns in the economy. According to him, businesses with a lot of debt should be avoided because if sales and cash flow suffer, they can find it difficult to pay off their debt. If credit conditions and lending standards become stricter, they can also experience difficulties refinancing debt when it comes due. Avoid growth stocks during a recession. The time to invest in growth stocks is not as we approach a potential recession. Growth equities perform poorly during recessions, particularly those of unprofitable businesses with strong growth prospects, according to Nakati. Consider additional dividend-paying equities and income-generating investments instead. Invest in dividend stocks. The best dividend stocks provide a cushion for your portfolio during recessions. Even if a company's stock price falls, it may keep paying dividends. Dividends can indicate strength and offer a method to dollar cost average during market volatility. Griffith says, consider actively managed funds. For fund investors, consider shifting into more actively managed funds during a recession. Research shows that most actively managed funds outperformed their peers by 4.5% to 6.1% per year in down markets after adjusting for risk and expenses. Don't overreact during a recession. Even if a recession is on the horizon, no one can know how long it will last or to what degree it will affect the stock market. Often, the best way to invest during a recession is just what you've already been doing. While recessions can be challenging for returns and growing wealth, we also see countercyclical rallies, and the market is always forward-looking. So the keys are to remain fully invested, not be whipsawed by short-term market gyrations, and to keep focused on your long-term goals. Nakati says, "Is it risky to invest when a recession is nearing? When an economy is nearing recession, chances are that markets will also fall as profits shrink and growth turns negative. During a recession, stock investors must use extra caution, as there is a good chance that they will see price depreciation of their investments. That said, timing a recession is difficult to do, and selling into a falling market may be a bad choice. Most experts agree that one should stay the course and maintain a long-term outlook even in the face of a recession, and use it as an opportunity to buy stocks on sale." Which assets tend to fare best in a recession? Not all assets are impacted the same way by a recession. As spending shifts to basics, consumer staples, utilities, and other defensive stocks may fare better. Companies with strong balance sheets will also be able to weather a temporary decline in profits more than a high-spending growth stock. Outside of stocks, bonds may rise and interest rates are cut in response to an economic contraction. Which stocks are hurt the most by recession? Growth stocks without strong balance sheets and high debt loads are often the most vulnerable to a recession. This is because they may find it hard to raise new capital as the economy contracts, while their profits can be eroded by lower consumer spending. Speculative stocks with shaky fundamentals are among the most risky as a recession hits. Fear fighters, to help manage the anxiety and fear that may arise from watching the market and economy as they move fitfully toward recession and the eventual start of the early cycle, it's helpful to have a long-term asset allocation plan as part of a broader financial plan. An appropriate asset allocation includes a mix of stocks, bonds, and cash that aligns with your goals, time horizon, and your ability to manage risk. Your plan can help you avoid emotional overreactions to volatility, so you can stay on track toward your long-term financial goals. What that plan looks like may depend on who you are. For investors who are a decade or more from needing the money in their portfolios to help pay for their living expenses in retirement, recession-related volatility may represent a chance to buy high-quality stocks at discount prices in hopes that they will rise as times improve. However, the entry into recession may have more implications for the portfolios of those near or in retirement, who may not feel that they can afford to wait for an eventual recovery in the value of their stocks. The bottom line: every recession eventually turns around and goes up over the long run. By developing a strategy based on countercyclical stocks with strong balance sheets in recession-resistant industries, investors can get in on one of the biggest market booms and avoid the turbulence that often results when the economy weakens. Long-term investors willing to stand through these volatile times eventually will be able to reap the rewards. They may also be able to sell quickly and buy more profitable assets when the bear market is in full force and position themselves ahead of the recovery for even bigger gains when the market improves. And there you have it, folks. Investing during a recession doesn't have to be as scary as it sounds. Remember, be the contrarian, focus on quality, diversify, hunt for bargains, stay informed, and be patient. With these strategies in your toolbox, you'll be surfing the market waves like a pro. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more finance tips and tricks. We love hearing from you, so leave us a comment below with your thoughts or any questions you may have. Until next time, happy investing, and may the recession-proof force be with you.